Welcome to a new video. My name is Zach, and today I will be sharing 6 stocks that just announced dividend increases over the past few weeks. I was just writing my Monday newsletter coming out and collecting the dividend news, and I thought, hey, why not make a quick video going over the news? By the way, if you want to get my newsletter, it's free, link in the description and pinned comment. So of the stocks I selected today, a couple are dividend aristocrats, and some are on their way to being future dividend aristocrats. And they are across a lot of industries, whether it's alcohol, gold, pharma, sofas, and even a top brand all of us know. First, we have Brown-Forman, ticker symbol BF.A or -A, depending on your brokerage. This company is a dividend aristocrat, and they just declared a $0.2265 per share quarterly dividend, which is a 4% increase from their prior dividend. And by the way, this company does have 2 different classes of shares. You have BFA and BFB. And here you can see that the company has sold off significantly since their 2020 highs, and that looks to be from a plateau in earnings per share. And the valuation has compressed significantly to now being a 19.99 PE ratio based on the earnings per share over the trailing 12 months of $2.07. And here you can see the company's dividend growth over time. This is a quarterly payer, although they do occasionally have large special dividends. For example, in 2018 and 2021, they had these $1 special dividends. The 10-year compound annual growth rate of the quarterly dividend is 6%. The payout ratio is sustainable over the long term. The current free cash flow payout ratio is 96%, and they seem to be having weaker free cash flow over the past 3 years. However, based on earnings per share, they have a payout ratio of 39.45%. And here you can see the decline in free cash flow per share for Brown-Forman. But this could be a buying opportunity for the company. They own top alcohol brands like Jack Daniels, for example. Oh, and I have to show you guys something. I'm a Washington fan, and I was wearing this earlier today, but they lost to the Cowboys. But our quarterback's name is Jaden Daniels. So I have this sweater that's like the Jack Daniels logo, but then it's made to look like Jaden Daniels, and it says Washington quarterback on it. Anyway, I thought it was funny. But anyways, they own a lot of top brands, whether it's Jack Daniels, Old Forester, Herodo, El Jimador, and the company was founded all the way back in 1870. So this sell-off actually could be a buying opportunity, as it's now the highest dividend yield in the past decade for Brown-Forman stock. And you wouldn't have seen a higher dividend yield since the great financial crisis. The stock has not done well over the past decade, especially with this recent sell-off. The 10-year total return is 27.21%. However, since 1990, this has been a long-term compounder with a total return over 2,600%. And you can attribute a lot of that to dividend growth and dividend reinvestment. All right, next up we have La-Z-Boy, ticker symbol LZB. They declared a 22-cent per share quarterly dividend, which is a 10% increase from the prior dividend of 20 cents per share. And if you live in the United States, you likely know this company. They sell sofas and recliners. Also, they have a Black Friday sale. And by the way, dividenddata.com has a sale going on right now. And I actually had never looked at La-Z-Boy stock before collecting these dividend increases, and it has actually done pretty well. They were in a real rough patch during the great financial crisis time period. Earnings were negative. The stock price was at insane lows. But really, over the past decade, they have continued slowly growing earnings per share. But it seemed like they had a little bit of weakness in 2023. And since 2012, this has been a dividend growth stock. Current annual dividend is 88 cents per share. That gives it a 2.01% dividend yield. This is a very sustainable payout ratio too. The 10-year compound annual growth rate of the dividend is 10.65%, and the past 4 dividend increases have been 10% each. The free cash flow payout ratio is 31%, and the earnings per share payout ratio is 26%. The company has even been repurchasing shares since 2014. The company has a total return of 100% over the past 10 years, which is better than Brown-Forman, but still trailing the overall market, and it has underperformed the market over the long term as well, with a 1,300% total return since 1990. So La-Z-Boy was a fun one to look at, but maybe not the best for your portfolio. Next up, we have Royal Gold, ticker symbol RGLD. They just declared a 45-cent per share quarterly dividend, which is a 12.5% increase from the prior dividend. So this is a gold company, but the more I looked into it, the more interesting it actually was. Gold is currently trading at an all-time high and had a fantastic 2023, but I personally do not own any actual gold, as I prefer to invest in productive assets, not non-productive assets. I've made videos about this in the past, and yes, I understand all the arguments about inflation, blah, blah, blah. And it is definitely preferable to fiat currencies in many ways. But in gold, I would probably rather own a high quality gold stock that paid dividends rather than the actual metal itself. And Royal Gold seems to be a pretty interesting one. You can see that they've had growing earnings per share growth and just had a fantastic 2024, which is expected with gold prices right now. The current annual dividend is $1.80 per share. That gives it a 1.21% dividend yield. The 10-year compound annual growth rate of the dividend is 7.42%. And this 12.5% increase is an acceleration in their dividend growth. The payout ratio ratio is sustainable too, with a 23% free cash flow payout ratio and 41% EPS payout ratio. But as I was researching Royal Gold stock, what I liked is that they are not a miner themselves. Instead, they basically have two businesses, stream revenue and royalty revenue. And streaming is basically making an agreement with a mining company to purchase part of their precious metal production at a predetermined price, often discounted in bulk. But the royalty business is even more interesting, as you just get a right to percentage of the revenue of metal produced from a project, after cost, of course. So in this version, you don't have to worry about selling the gold at all. So the reason why I like this business better than a lot of gold miners is the margins are way better. 85% gross profit margin, a 56% operating margin, and a 43% net profit margin. They don't have to deal with any of the operational risks associated with mining. And over the trailing 12 months, their revenue is primarily gold. That's 51.9% gold stream and 24.74% gold royalty revenue. So Royal Gold seems like an interesting dividend growth stock to consider if you want to invest in gold. The 10-year total return for Royal Gold stock is 141.6%, which is pretty solid. It's mostly done better in the past year at 26.22%. However, since 1990, Royal Gold stock has done fantastic. It has an 11,800% total return. For stock number 4, I have Merck, ticker symbol MRK. They just announced an 81-cent per share quarterly dividend, which is a 5.2% increase from the prior dividend. This is a big pharma company which has sold off recently, and you can see that they've had some difficulties in earnings per share over the past couple of years. But this sell-off is giving the company a 3.27% dividend yield, which is in the historical high range. Merck is a long-term dividend growth stock. The 10-year compound annual growth rate of the dividend is 6.55%. And in recent years, they've been consistently around the 5% mark. The most recent dividend increase at 5.19%, two prior being 5.48% and 5.8%. And historically, the dividend is sustainable, although in this most recent year, the free cash flow payout ratio is up to 81% and the earnings per share payout ratio was 2,000%. And if we look at their net income, they booked a huge loss in Q2 2023. I assume that's from some investment write-down they had. However, if you're looking at the bright side for Merck stock, they do generate very high free cash flow. In their most recent Q3, just generated record free cash flow per share at $3.36. That was almost as much as they had in total in fiscal 2023, all in one quarter. That was $8.5 billion they made for free cash flow in that quarter. I don't follow this company that closely or invest in pharma, but if you are positive on the company long-term, then the sell-off could be the start of a buying opportunity. Now, what you should know is that this is a pharmaceutical company primarily, with 89.4% of their revenue coming from pharma and 49.3% of their revenue in the United States. And they have a lot of different products. I'm not an expert though on their business model, but they do have some vaccines in different categories as well. I know they're one of the bigger vaccine companies. So a risk you should be aware of is in the United States, we now have RFK Jr. as our future Health and Human Services Director. So there is a lot of uncertainty around regulation in big pharma and especially in vaccine products. And I have no doubt that attributed a little bit to their recent sell-off. However, it does make the company a little more financially attractive as the dividend yield is the highest since 2022. However, historically, there has been many opportunities to get a higher starting dividend yield for Merck stock. So purely in terms of dividend yield, it might not be the most attractive even right now. The stock has done all right with a 10-year total return of 137%. And since 1990, it has seen a total return of 2,200%. All right, with stock number 5, we have Nike, ticker symbol NKE. They just announced a 40-cent per share quarterly dividend, which is an 8.1% increase from the prior dividend. And if you want to learn more about Nike stock, I recently made a full stock review video. Some of the big news is that Bill Ackman recently bought a large chunk of the company. It's his second largest position, and the stock is down 55% from its 2021 highs. That boosts the dividend yield to 2.07%. And Nike is a long-term dividend growth stock on its way to being a dividend aristocrat. The 10-year compound annual growth rate of the dividend is 11.07%. This is slowing down with the most recent increase being 8.11%. But this is a very interesting dividend because it has the combination of decent starting dividend yield with a low payout ratio and high dividend growth. The free cash flow payout ratio is 32.7% and the EPS payout ratio is 38%. Nike is a very interesting opportunity to look at right now. They have one of the best and most valuable brands in the world. They make 64.8% of their revenue from footwear and 26.8% of their business from apparel. Again, if you want to see a full breakdown of their stock, then watch my full stock review video. It is currently trading at one of the highest dividend yields in the past decade, and the dividend yield for Nike stock has only been higher in the great financial crisis. So this has the potential to be a very very strong buying opportunity for the stock. Even with this 55% sell-off, the 10-year total return is 77%. And when the stock was at its 2021 high, the total return was 291%. And since 1990, this has been one of the most reliable compounders in the stock market. Even with this 55% sell-off, it was a 12,800% total return. And that was as high as a 30,000% total return. So Nike may be a very interesting dividend growth stock to start adding to your portfolio. And finally, at stock number 6, I have Motorola Solutions, ticker symbol MSI. They just declared a $1.09 per share quarterly dividend, which is an 11.2% dividend increase. And this is not a company I have analyzed or even looked at their business in a very long time. So I had stupidly thought this was the cell phone company, but they spun out that business in 2011. So this is a business valued at $83 billion I didn't even know anything about. And recently, they've been on an absolute tear in stock price. I mean, look at that growth. That's insane. This is a dividend growth stock too. The 10-year compound annual growth rate of the dividend is 12.36%. It's sustainable with a 32% free cash flow payout ratio and a 34% EPS payout ratio. And the company has been growing free cash flow per share consistently with a 10-year CAGR of 14.25%. And let's take a look at how they actually make money today. 64% of their revenue comes from products and systems integration. This is infrastructure, devices, accessories, video security devices, and the integration of those systems for government, public safety, and commercial customers. That includes things like two-way radios, video cameras, radio networks, video analytics, and access control solutions. So I wouldn't say this is the most high-tech company, but it seems like they're pretty embedded and have a good sales cycle with big money customers like the government and other large corporations. And it seems like they'll do whatever makes money, because if you go on their website, they have safety and security ecosystems for active school threats like school shooters, missing child, road accidents. I had no idea Motorola was doing any of this. And at 35.97% of their business, they have software and services. It seems like they offer this on-premise and as a service, so it could be a subscription software company. And I assume this likely connects to a lot of their products they sell as well, because this is for repair, technical support, maintenance, monitoring, cybersecurity, and command center. So just in my brief analysis looking at the company, if you're bullish on Motorola, I assume it's from that software segment, because that's likely much more higher margin and it seems to be subscription revenue. Since fiscal 2016, that has grown from a $1.6 billion revenue business to $3.8 billion over the trailing 12 months. And surprisingly, this has been the best returning stock of the 6 I looked at today over the past 10 years. The 10-year total return is 805.6%. And if we look at it since 1990, that's a 3,900% total return. And that was despite the massive disruption they faced over decades. This stock was an absolute loser from 1995 all the way to 2018. If you had owned the stock that entire time, you would have had no returns. But it seems like they got out of their bad mobile business, and in the past decade, they've been building a new growth business. So hey, who knew? And the only reason I knew is because I used my website, dividenddata.com, to research the stock. And you can as well with our new AI chat tool, plus our stock analysis and dividend news features. You can sign up today and get 50% off for life, lock in that price for life. This is the best deal we will ever offer. Link in the description and pinned comment of the video. And if you found this to be valuable, then leave a like and subscribe to the channel. And don't be afraid to join our free email newsletter as well. Thanks for watching, and I'll see you in the next video.